So India's biggest private airport operator, Adani, has a huge choice to make. Should they jack up prices to build this futuristic empire they're dreaming of? Or do they keep things cheap to get more and more people flying? It's a really high-stakes game, price versus passengers, and we're about to break it all down.
This whole thing kicks off with a pretty wild idea. Just think about it for a sec. What if an airport wasn't just, a place you go to get on a plane? What if the airport itself was the destination? Like a giant shopping mall that just happens to have a few runways attached.
And look, to really get why this question matters so much, you've got to understand just how big these guys are. Right now, they handle a full 25% of all passenger traffic in India. That's huge.
And it doesn't stop there. When we're talking about air cargo, moving stuff around, their slice of the pie is even bigger. We're talking 33%. I mean, think about that. In less than 5 years, they've become an absolutely dominant force in the Indian skies.
So, the big question is, how on earth did they build this empire so fast? Well, let's take a look at how they got so powerful.
And believe me, the scale here is just mind-boggling. They've got 7 airports up and running right now, with another massive one in the pipeline. This whole operation is valued at something like $20 billion, and their profits are just soaring. Their strategy is super clever. They're building what they call a twin airport fortress, especially around the key hub of Mumbai, to basically make it impossible for anyone else to compete.
Right, so this fortress isn't just for show. It's the foundation for that big, ambitious vision we talked about at the start. It's what the case study calls the Mall-with-Runways plan.
Now, don't get me wrong, this is way more than just adding a couple more perfume shops. This is a complete, fundamental shift in how they think about an airport. The whole idea is to turn airports from just, a piece of infrastructure into these full-blown lifestyle ecosystems. They're betting that the real money isn't in charging airlines to land planes. Nope, it's in everything else. The shops, the hotels, the convention centers, all the massive real estate they're planning right outside the terminal doors.
And this chart really shows you just how revolutionary this plan is. Right now, their money is split pretty evenly, 50-50, between flight stuff, the aeronautical revenue, and the other stuff, the non-aeronautical. But look at the goal for 2030. They want to completely flip that. The plan is for a whopping 70% of their cash to come from all those non-flying activities.
Okay, but a vision this huge, well, it doesn't come cheap. And this, right here, is where the problem starts to bubble up. So let's talk about the real cost of all this ambition.
Let's put a number on it. We're talking 20,000 crore rupees. That's about 2.4 billion US dollars. And that's just for the stuff they call city-side developments. The hotels, the malls, all that. It's an absolutely massive investment.
So where do you get that kind of cash? Well, you borrow it. A lot of it. They've already raised $750 million in debt. And look, when you've got a loan that big, you have one job and one job only. Make cash and make it fast so you can pay it back. And for an airport, what's the quickest way to do that? You got it. You raise the fees you charge the airlines, which of course gets passed on to you and me, the passengers.
And this leads us straight to the heart of the problem, the real tug-of-war in this whole case study. It's a classic business dilemma, really. Do you go after a sky-high valuation for your company, or do you focus on getting the highest possible number of customers through the door?
And it's not like this is all happening in a vacuum. The industry is starting to push back, and hard. You've got the International Air Transport Association, IATA. They basically represent airlines all over the world, and they've put out a pretty serious warning. They're essentially saying, hey, these massive fee hikes could actually hurt the growth of the entire aviation industry in India. All right, so let's really lay it all out. On one side, you have all these reasons to jack up the prices. They've got that huge debt to pay off, they need to fund all this crazy expansion, and this is key. They're planning to go public with an IPO. And for an IPO, the more cash you're making, the higher your company's valuation is going to be. But then, on the other side of the coin, the risks are just as big. The airlines are already complaining loudly. And remember, India is a very price-sensitive market. If flights get too expensive, you risk scaring away the exact same people you need to shop in your shiny new airport malls. And here's the kicker. They can't just wait and see. There is absolutely a ticking clock on this decision. That debt, it's on the books now. The pushback from the airlines, it's happening as we speak. And that big IPO is scheduled for just a couple of years from now. They have to get this right, and they have to get it right soon.
So, that brings us right into the boardroom. Imagine you're there. This is the decision on the table. For the rest of this breakdown, I want you to step into the CEO's shoes. It's your call. Now you decide.
So, as the case study shows, there are really two clear ways to go from here. Path number one is to prioritize valuation. You just keep pushing those aggressive fee hikes. You make as much cash as you can right now to pump up that IPO valuation and get the best possible price. The angry airlines, you can worry about them later. Then there's path number two, prioritize volume. Here, you ease up on the price hikes. You keep flying affordable. Make sure more and more passengers keep coming because they're the ones who will make your whole Mall-with-Runways ecosystem work in the long run. The trade-off? You might get a lower valuation for that IPO in the short term.
So, at the end of the day, it all boils down to this single question. If you were the CEO, what would you do? Do you use your powerful market position to get premium returns right now? Or do you play the long game and focus on building this massive, low-cost engine that runs on a huge volume of passengers? It's a classic trade-off, really, short-term gains versus long-term growth. So, what's the right call?